Good morning and welcome to the Fortress Interim Results presentation. Thanks to everyone for dialing in. This is the 6-month results to the period ended 31 December 2020. We did release our results last night on SENS, and this presentation is on the website if you want to log on and download it. You can do that. We released it about 30 minutes ago. So just to touch on a couple of highlights for the 6-month period. I think most notably is we did come to the market a few years ago. We had acquired about 2 million square meters of land, not all of it 100% owned by us, which converted into approximately 1 million square meters of GLA, which we had to get developing and get letting. It was admittedly quite a big pipeline at that stage. I think really the highlight for the last 6 months is of that 1 million square meters, we've completed and developed about 250,000. But during the 6 months, we've secured tenants and received offers on 340,000 square meters of that 1 million squares. And we'll touch on how much we have left, but we've sort of chewed through just over half of that pipeline, which I think really does de-risk it and speaks to the capabilities of our development team. Also, very pleasingly, another highlight, we sold 1.1 billion of properties, marginally above our book value, and we have another 371 million held for sale, so we're using that cash to build the pipeline. Strong balance sheet, LTV reduced marginally to 38.1%. We did acquire 2 logistics parks, a very small investment in Poland, in new warehouses with a bit of a pipeline. Vusa, our retail executive, and his team managed to do a stellar job and maintain trading densities in our retail portfolio at the same level, marginally higher than 2019 for the comparable period. And I think pleasingly also we reduced our vacancies from June from 8.9 to 6.8% of GLA, and continued our solar rollout, which is not only economically very lucrative in terms of the returns that we get, but also I think a strategic imperative for sustainability and something that our tenants do value. So up on the screen now, we've just got an overview of our current asset base. We've been showing this for a number of years. We still have non-core assets of about 6 billion. We have reduced that quite dramatically over the last few years. So SA direct offices and a little bit of land we have there, the direct industrial and other, which is motor showrooms, hotels, a few residential properties of 400 million. So that 6 billion is non-core. We're looking to dispose of that and chewing through that. And then we obviously have our core portfolios, SA Retail, SA Logistics, our logistics development pipeline, and then our investment in Nepi Rockcastle. So that's where we are as of 31 December. And this next slide is really our target asset base over the medium term. Where do we want to go to? And I think we've got 2 core portfolios. We've got logistics and our logistics developments, and we've got our retail, which is focused on convenience and commuter-orientated centres, and then obviously Nepi Rockcastle. So if you look at that relative split, we really want to try and simplify the business. And I think rather than be a multi-portfolio monster, we're focusing on what we've got core competencies in, which is logistics and retail, both in South Africa and in Central and Eastern Europe. So that's largely the target asset base, 40 to 50 billion, so more or less the assets we've got now. And how do we achieve that is selling the 6 billion of non-core and using 3 billion of that to roll out our SA pipeline, of which we also have 3 billion of work in progress, so that'll get us to 6. So we'll end up there on the left-hand side of that of your screen there in the blue, about 15, 16 billion of SA Logistics, relatively small, roughly 2 billion in Central and Eastern Europe, and then 20 to 25 billion of retail exposure. That's really where we headed, which makes us far less diversified and far more focused. So this is just a strategic focus to really get us to our asset base. As we mentioned, 6 billion of non-core asset sales. We're hoping to hit our target of close on 1 billion rand for this year, and then using that cash to roll out our pipeline. Currently, we have 312 million squares of GLA under development or in the process of planning and agreeing terms. After that, we'll have about 440,000 square meters in SA. We've got 110,000 square meters in Central and Eastern Europe. So we need to focus on letting those and rolling out that pipeline. Just something there to give you a sense. So we've got about 3 billion land and developments in the logistics portfolio in South Africa. Top structures will be about 3 to 3.5. It depends on the JVs and what we actually build, if tenants require co-ownership. But at the moment, our pro rata share after co-ownership with our tenants is roughly about 3. So that'll give us 6 billion of income producing assets. And if we then look forward, if we execute on that 6 billion of non-core sales, 3 billion of pipeline, it will give us a little bit of a cash buffer of circa 2 to 3 billion. And obviously what we do every day when we come to the office is just focus on the core assets. A lot of that at the moment is refurbishments, making sure we've got the best product for the tenants, focusing on asset management and offering tenants value, which I think for the good tenants, that's really what they seek, and building on that tenant retention and tenant relationships, and then being open to innovative ideas in terms of asset management. Just a portfolio overview. At the back of the presentation, we've got it broken up into our portfolio silos. This is the whole portfolio. So, I mean, I guess it becomes a bit meaningless when you put it across 4 or 5 different portfolios. But pleasingly, our vacancy did come down. Vacancy by value also came down. In-force escalations marginally down, but still sitting at an attractive 7%. I think the telling number there is reversions over the 6 months, which we have said in the past it is a relatively small sample size, but it was a tough 6 months trying to renegotiate, with the pandemic. So reversions were quite negative, and the lease expiry profile slightly shorter than it was. Vacancies, I think a pleasing performance to get that down to 6.8% of GLA, 5.2% by value. The logistics ticked up a little bit. I think what is of concern is the office vacancies. I see it's not out of line with peers, but that's really something that we are looking to address. But fortunately, as a component of our overall portfolio, it's quite small. And then the best performance was in industrial. We managed to let up quite a lot of the larger industrial boxes, which is very pleasing, and I think that's also leads into the like-for-like. I'm going to hand you over now to Ian Forster. Our CFO is going to take you through the financial performance.
Morning. Thanks, Steve. Appreciate it. As we explained in our pre-close call in December and confirmed 2 weeks ago on SENS, we will not be paying a distribution to our A shareholders and, in fact, our B shareholders as a result of our distributable earnings being less than the A minimum entitlement as contemplated in our MOR. So what that means is our MOR it prohibits us from paying a distribution in that scenario. The A entitlement for this period would have been 80.1 cents, and that will become the base for the first half of 2022. Our simplified distributable income slide seeks to show how our distributable earnings is made up, and it sort of eliminates the noise that IFRS creates in our normal income statement. So if I start at the top, our net operating income from our properties, that is obviously rental and recoveries net of expenses, including our investments in Arb and Galleria. Dividends accrued from NEPI, we include that as, whilst it's an accrued number at 31 December, we include it in our cash in nature box there, and that's really as a result of it coming to us in March in the form of cash, and that on the timing would have been more or less when we would have been paying a distribution. So it is classed as cash. Interest paid, banks will only receive cash from us, they'll only accept cash. Interest received on our cross-currency swaps. So we had mentioned previously that we had negated the effects of the cross-currency, which has now been closed out. That was done prior to June last year, but there was some interest received for this 6-month period, but was received in cash on a quarterly basis. Interest on our staff and development partner loans, the bulk of that relates to interest on our development loans. There's about 9.4 million that relates to staff loans, and we still have the staff scheme loan adjustment of 9.1 million, and that is not to distribute the non-cash backed portion of that interest. Interest rate derivatives are swaps and caps, and that's really the cost for our interest rate protection. Swaps, if we have a swap of say 7% and we're paying roughly 6.5%, that differential gets settled also on a quarterly basis. The cap's somewhat different. The cap is an amortization charge attached to the premium on entering into that product. So what we do then is we amortize that cap premium over the lifetime of the product, so as to not burden a current shareholder with a future benefit or vice versa. Admin costs, obviously cash in nature. There's a small portion that gets capitalized to our development, in our developments, and that's really for our development capabilities on the basis that it's done internally and not paid for externally, which would have the same result if we were to pay a third party and capitalize it to our buildings. CSI expenditure, cash in nature, and that includes our BE initiatives. What you don't see there, which is different from prior periods, is that of capitalized interest. We introduced a Fortress-specific distribution policy last year this time, and that was to exclude paying out capitalized interest on our land holdings. And as Steve's already mentioned, with the new buildings coming online, etc., that will then turn into direct NOR from those new buildings without the effects of capitalized interest. Given that we won't be paying a dividend for this first half, the question may be, how do we satisfy the requirements of 1347 in the listing requirements, and that's to pay out 75% of our distributable earnings. This is obviously the dividend or distributable income calculation from a REIT best practice and Fortress perspective. Given the nature of our earnings that we actually received for the 6-month period, which would include that of the capitalization issue by NEPI, we're pretty confident with those earnings and the next 6 months, as well as the anticipated dividend to be paid in June, that we will satisfy those requirements of the JC being the 75% of distributable earnings as defined. Our NAV bridge, again, this was a metric we introduced about a year ago, is the NAV per equity share on a going concern basis. Just a bit of background to that. Our MRR contemplates, not sure what's happened to our numbers on that screen, but our MRR contemplates a scenario in winding up a liquidation in which the A share would receive a 60-day VWAP. In the absence of those scenarios, we've calculated a NAV per combined equity share, and which is roughly 10 Rand and 94 cents at June and 11 Rand 35 at December. Some of the notable movements there, whilst the numbers don't appear on your screen, the small increase in direct property is really as a result of the acquisition we've done in Poland. The material move there in our listed portfolio is the effects of NEPI. Whilst we equity account for that investment, we in effect revalue the balance that we carry on our balance sheet to the market price at reporting date, and there has been an uptick in that price from 30 June to 31 December, resulting in about R1 billion increase in our NAV. The next big mover is a decrease to our loans to partners, and that was as a result of some cash that we've received from our development partners at our Cornubia site. And then our borrowings are marginally up, primarily to fund the acquisition that we've made in Poland. From a liquidity and funding perspective, we're well placed. We have roughly 2.8 billion rands worth of cash and available facilities. Our LTV, as Steve had mentioned, is marginally down at 38.1. Our see-through LTV, applying NEPI Rockcastle's reported EPRA NRV, is 35.6%. If we move on to funding, we managed to place 680 million rand in the debt capital markets from when we last reported. We've also repaid 300 million in that space. So we've placed 560 million in a 3-year note, been in October last year, 300 million, and the balance in Feb this year, tapped to the same note, and a further 120 million in a 1-year note. What's important to note there is that the credit spreads on the DMTN placements are similar to that of our secured debt. So it would appear that there's still appetite for Fortress paper and at competitive rates. We have approximately 4.4 billion rand worth of maturing debt, and I'll get to our debt profile shortly, in the coming 12 months, and that's 12 months from our 31 December reporting period, the bulk of which sits in the third and fourth quarter of the calendar year 2021, of which 3.6 billion has already been credit approved. We've had no breaches in our covenants, and the relationships with the banks are still strong and good. With regards our interest rate hedging, I think it's quite a busy slide as well, but the important point here is of our adjusted variable rate exposure of 16.3 billion, 11.6 of that is covered by way of swaps and caps, which is 71%, and for a tenor of 4.6 years. So well within our stated policy. Just with regards the protection that we have, we're still favouring caps, and you can see by this slide we're roughly 53% weighted in favour of caps, 47 swaps. A year ago we were favouring caps because of the exceptionally high real interest rates, and the idea was that you'd capture any benefit on the way down. Now we're favouring caps because of the exceptionally high or steep curve weighted to the long end. And so long as the interest rate doesn't move along that profile, we would capture that benefit in time to come. Obviously, it comes at a significant premium. As mentioned before, that's the charge that we take in amortization over the life of those caps. With regards our maturity profile, we've split the portions into secured and unsecured debt. I've already sort of mentioned that we have roughly 4.4 billion in the coming 12 months, so that those numbers that you'd see on the slide are by financial year. But within the coming 12 months, we've already refinanced 3.6 billion. Another important note on this slide is that only 10% of our circa 20 billion rands worth of facilities sits in the debt capital markets, and we do have appetite to do more. And with that being quite low, there's obviously a very low refi risk attached to it. Our cash collections for the first half of this financial year, or the 2021 financial year, for the 6 months at the portfolio level, 98.9%. By portfolio, retail 100, logistics 98.2, industrial 98.1, and office 98.8. Just an important note here, so the way we measure this is of what we build in a particular month is what we've collected. So any COVID-related discounts, we effectively don't treat them as a billing. So they stay out of the earnings, they stay out of the distribution, they're not straight-lined or smooth. And then the cash collection attaches only to what is actually billed and collected in the month. For the 2 months at a portfolio level of January and February, we collected 97.7 and 99.8. I think what we can see there in Jan is some of the pressure coming through from the semi-lockdown or semi-lockdown introduced by government sort of mid-December. Just to end with NEPI, as I've mentioned before, we effectively mark to market the investment in our books, and there is an uptick from June, 88 versus the 93. But our share, whilst remaining static as a percentage of shares in issue by NEPI, those additional 4 million shares that you see there is really as a result of the capitalisation issue that they did in October 2020. So I'm going to hand you over to Vuso now, which can speak to some far more exciting stuff in our retail portfolio. Thanks.
Thanks, Ian. Good morning, everyone. You'll notice that there's a slight decrease to our value and the GLA. That's because in line with our strategy of selling the tail of our portfolio, we've sold 3 assets in this reporting period, with another 2 that we've signed agreements, but those have not yet transferred. But they'll transfer probably before June, so that number will come down a little bit again. So it's been a tough period to do negotiations, particularly on rentals. You see that we've got negative reversions of 7%. I think that we opted or prioritized tenant retention in a market where costs were going up for tenants from utilities and things like that, but also the trading environment. The economy is not conducive for a particular good growth. So I think we've done our best to contain those. It is disappointing to us, but I think in the environment we sort of understand what's happened there. We are still doing renewals. I mean, we've got a 90% retention rate. We renewed 204 leases in this period, and we signed 77 new leases in the period. We're still able to get between 7 and 6% escalations, and the lease tenure varies between 3 and 5 years in most cases. We managed to decrease our vacancies from the 6% reported in June to 5.3%. We expect this to decrease further when we transfer West Street. We'll probably decrease this by another 1.6%. Our team is working hard on reducing these vacancies even further. So hopefully June, this number will look better. Collections have gone relatively well. So we're back at collecting 100% of what we bill, as Ian said, after the adjustment for COVID relief. We have continued to work with tenants, particularly restaurants and bottle stores in the most recent period. I think the COVID credits that we passed in the 6 months was 6.6 million. But in total, since COVID started in April last year, or the pandemic in April last year, to February this year, we've agreed credits with tenants amounting to 75 million rands. What we're trying to illustrate with this slide is that in the last 6 months, July to December, our retail sales have returned to pre-COVID levels. It's been a bit of a roller coaster ride since the drastic decrease in sales in April. You can see there. October was the first month where retail sales were above the previous year's sales levels. But then again, in November, it decreased again. I think most of that was due to the poor performance on Black Friday. December was pretty flat. And what we're seeing in January and February, well, January was down, driven by the delay in the back-to-school season. But February and March, so far in March, the tenants are telling us that it's much better trading. This slide here just gives a bit more color on the different categories and how they performed in the 6 months. You'll note that the rural portfolio is performing very well. That's the one in the purple there. It's probably our strongest in this period. The township centers have recovered the slowest. Those are the ones in green. But what we've seen is that similar to what we reported in June, the grocers and the pharmacies are doing really well. And of course, at leisure, hardware are also doing well. You would have seen the Cashbuild results recently. Cashbuild is in our top 10 tenants, so that was pleasing that they showed good growth. Still under pressure, restaurants, fast food, and bottle stores, although those are improving since the relaxation of the lockdown conditions. As mentioned, the rural centers are performing fairly okay. Particularly our assets in the Eastern Cape and KZN showed good growth. I think some of that is influenced by the fact that a few years ago we revamped and extended some of them, being Nongoma, Sterkspruit, and Kokstad. So that's coming out nicely. In the townships, as I said, growing a little bit slower than the other portfolios. I think the employment numbers have an impact, or the drop in employment has an impact. What we're seeing is that there is some customers that are closing shopping accounts. And a comment that was made by one of the center managers at one of our centers is we're seeing more people just hanging around the mall, people that went there during the week, which is a sort of an indicator of what's happening there. Also, even though the grocer sector is positive generally, I think within the townships, we're seeing that the grocery category is pretty much flat. But it's still fairly strong. It is, I think we're also seeing that the government social spending is supporting this, particularly the 350 Rand grant. Some of the tenants are reporting that they're seeing more lay-bys. So guys postponing or paying off their purchase over a certain period of time. In any case, nonetheless, we are pleased with this performance. I think it is under the circumstances, it is pleasing performance. The CBDs and suburban centers also performing fairly well. I think both benefiting, well, more the suburban centers benefiting from people working from home and looking for a more convenient center, and the CBDs from the fact that people have gone back to work or going back to work, and the relaxations on the public transport restrictions have also helped in there. So our focus going forward is that we will be, as I mentioned earlier on, we are selling our tail, but on the other side, we are expanding and redeveloping some of our existing assets where we see value. The ones that we'll be doing immediately are Palm Springs, Mafikeng, and Vescas. At Palm Springs, we'll be adding an additional grocer. We'll be improving the parking area and adding a public transport facility. At Mafikeng, we've commenced with expanding the grocer offering there. We will be adding a Clicks and more line shops. At Vescas, this is more of a renovation or a revamp. This center is 12 years old now. Looks a bit tired, so we need to freshen it up just to make sure that it retains its dominance in that West Coast. There are some, so the properties that we have sold, so there are some more assets that we're looking at to do redevelopments, and those are at various stages, mostly at council approval, all those sort of things. So I think in this year, you'll see a few more coming through. With regards to the assets that we're selling, the ones that we sold, the 3, Groblersdal, Potchefstroom, and Protea, I think there we had extracted the value that we're looking for. We are waiting for West Street and Nongoma to sell. That should come through now. We are in the market to buy new assets in the commuter and convenience categories. New developments or existing stuff, existing properties we'll look at. Obviously, the price will determine where we go, but we are in the market for that. I think there are opportunities. I think what we're seeing in this past year is that the category where we play, which is the commuter market and the convenience center, it's quite resilient. It's a market that we like. We do see opportunity going forward, and hopefully we'll land 1 or 2 opportunities. Thank you very much.
Yeah, Thanks, Vusa. I think a pleasing performance there from the retail team. So we're going to whiz through a couple of videos now. They are back to back, so I'll just talk to them as they go. These are really just on our main parks. So the first one we have here, Clearwood. It's the big one in Durban. It's taken us a long time to get this going. We let the first building to Samar. You can see some containers there. We've done something which is quite exciting. It's a container terminal at the back where there wasn't much land. Hopefully getting a rail siding. That's still under negotiation with Transnet, so we'll probably be saying that for the next couple of years. That's Pocket 4A and B, which we've let most of to African Sugar Logistics. We still have a little piece of one of those buildings to let out, but it's gaining a lot of momentum as people see the buildings coming up, and I think King's Rest Container Terminal there of 56,000 squares is also attracting quite a lot of interest. They've got big tenants such as Costco and Maersk and guys like that. So, you know, I think Clearwood's picking up. We've done some, I guess you could call them MIDI units on a little finger that protruded. So we had a little bit of extra land right at the back there along the railway line. So we're doing some MIDI units there. The next one, Cornubia Ridge. So we did the macro a couple of years ago. We built 23,000 squares there. It was a little bit big for the market, so we had to split it to 14,000 squares, which is let to, it's Arista, I think the official name is UPL South Africa. They do a lot of chemicals logistics. And then 9,000 squares on a 10-year lease to Retailability, which was the company that bought Edcon and I think owns a few other brands, the Jit and Beaver Canoe. You can see the racking coming in there for UPL. They did need a little bit of financial assistance with the racking, so we provided that to them, and again, I think we get a pretty good return on that, so that's something that we've done before with a number of tenants. Long Lake, we announced the pre-let deal with Zest about a year ago. That's 24,000 squares, and then we built a little 12,000 square meter box at the same time, which was let round about completion to cargo carriers. So that one's done. It's a really great node. That whole Modderfontein area is being unlocked. You know, new roads, easy access, exactly the kind of product that we really think the good tenants are looking for. We have a little bit of land at the back there across the road, just slightly up the hill, which we can do another 60,000 squares on phase 2. So this is done, and now we're looking for tenants. If you look there on the right-hand side, looking for tenants on that 60,000, probably do 3 20,000 square meter boxes or something like that. But I think you know, the node has taken off. Loladia, I know that our Chief Operating Officer loves to brag about this one. It is our most successful park, 89,000 square meters. We Buy Cars, Goldwagen, Vodacom and USN. We Buy Cars has bought half their building, Goldwagen has bought half their building, which again is a model that we really like. It recycles capital, it gives us a much better yield on our cost after factoring in that profit on the sale, and it binds the tenant into the facility. So this has been a great park. Pleased that USN are there. They've signed a 10-year lease. Just to the south of that, so if you sort of looking there now, further up on the screen, with that, we're looking to do phase 2 there. We are chatting to the landowner, looking to do JVs without land banking. So I think that given the demand in the area, we will hopefully be able to do another circa 50 or 60,000 square meters of boxes there. It's been a really great park, this one. That's the N1 at the moment, and then the Gautrain just to the right of there. So tenants who need a bit of exposure really do like this park, like We Buy Cars. Eastport, our biggest logistics development. That land there that you see on the left-hand side, we sold that to Terrico, who build data centers. They're going to build a data center there. That's a spec box, roughly 20,000 squares. We've got another one of about 13. And then the one at the front against the highway, 14,000 squares, was let to Clipper. They also do a lot of logistics for sweets and food. They also will buy half their building at, again, a compressed yield, so we like that. Savino del Bene, the one just next to Clipper along the highway, bought the whole building. We announced that last year at a 7.29% yield. And next to Savino, in a box that looks pretty similar, Toralco Logistics, not to be confused with Terrico. They do logistics for Tiger brands. So there's a lot of food food products in there. And I think, one of the exciting things that we're looking at here is a large distribution center, which will take up about 360,000 squares of this land. We'll show you a map now. So if you look on your screen there, that's the map of Eastport. It was 1 million squares. It was quite a daunting size at the beginning, but we really have chewed through that. So as we said a while ago, our approach is more of a developer approach to maximize economic profit on this. So happy to sell land, happy to do turnkeys, happy to JV. This large DC, which is under offer, we haven't finalized the terms yet, nor the design, looking like 160,000 square meters, and there will be some co-ownership involving us and the tenant, with our partner who owns 35% of Eastport looking to exit. So this one's quite exciting. We do have 2 spec boxes coming at us in the next couple of months, but quite a lot of interest there. I think that R21 north-south road is far less congested than the N1, so it seems to be gaining a lot of traction. This is just an overview of some of the portfolio stats for our logistics portfolio. Our share is increasing in terms of GLA, so that's kind of speaks to the strategy that we want to follow of logistics and retail. Building value per square, I think it's still quite fair. There is a little, the new stuff is sitting at sort of 8.5 to 9.5, and the slightly older stuff a little bit lower than that. I think if we pick the good and the bad of this slide, the good is like-for-like NOI growth of 2.3%, which is really great. I think it's, in this market, 2019 to 2020, the second half of those years, I think that's a great performance. Still relatively low vacancy, nice in-force escalations, and the standout negative on the slide is the reversions. We had a few negative reversions coming off some longer leases which reverted down. Again, it's 6 months, so that sample size is a bit small. So this is just the progress that we've made in our lettings in the pipeline. So during the period, what we've completed and let, just over 62,000 square meters. In the commentary, you'll see 62,495. The difference is in Cornubia, given the split, we didn't build a bit and we lost a bit. So that one wasn't quite the GLA that we had in the initial plan. It was a little bit smaller. So I think that's very pleasing. And then developments completed, but just after the period, both of which have been let, is Long Lake Extension 4, which, as we said, was let to cargo carriers on a 5-year lease, and Clipper was completed on a 10-year lease at a 9.4% yield. So that really is pleasing. And then if you look currently under construction, we've got Clearwood Pocket 7, which is the midi units. I think that Durban market is still, it still amazes us at how strong that Durban market is in and around the port. Then we've got the 2 at Eastport, which we mentioned, a little bit to let at Clearwood Pocket 4B, and then the container terminal. So, we've got GLA of 152,000 squares, of which we've let 90,000. No vacancies on anything that we've completed. So it really is going well at the moment in terms of the logistics. This is a summary slide. So our logistics under development, which includes land, 2.9 billion of value, as we mentioned right at the start. We need to add 3 roughly to get to 6 of income producing. Loladia is done. Eastport, we've kind of sold some land, so that goes from 450,000 GLA that we're thinking of doing down to 420. So that we've done 61. That gives us available of 358. As we mentioned, the large DC under negotiation is 160. The 2 spec boxes 33. So that leaves us with 165 approximately to develop. Long Lake, as we said, that's phase 2 of 60,000, but 36 is done. Clearwood, we've done 25,000, and we've got the 90,000, which is actually let, and then we've got a little bit of spec, which is the middies at Pocket 7 and the rest of Pocket 4B. So that leaves us with 155. Cornubia, quite small, 61,000 squares to go. So I think this is just a summary of, we were at 1 million squares a few years ago. We've done 250,000. We've got 750,000 left. We've got a little over 300,000 under negotiation, let, and under development. And that leaves us with 440 roundabout of remaining GLA to go. So we really have focused on getting through the land and chewing through that as economically beneficially as possible. So I think that's working, and credit to our development team. I think we've mentioned most of this, just really focusing on converting our land into a yielding asset base. It did, in a strange way, before we stopped paying out capitalized interest. If you were a shareholder, it had a yield when we capitalized the interest of circa 8.5%, 9%. Since we stopped that, it now, if you're looking from a share perspective, doesn't have a yield. It never actually had a yield. We didn't get any rental. So, just turning that tap off saves the balance sheet. But the advantage of that, as Ian mentioned, is as we develop these, all of that net income drops to the bottom line. The office portfolio, I think it's tough out there. Credit to that team. They do, I think they go out there and do the best they can. It is really, really difficult. Reversions down 16%, our vacancy up to 26, looks like it may be heading to 30.